All right. So we're going to just give it a minute to have people kind of tune in because this is some exciting stuff, right?
Yes.
Wow.
Oh
How many? Oh my God. Mortgage income is so amazing. So I can't tell you how many times I've had successes through just knowing
how to calculate
income and knowing how to be badass at it and knowing how to extricate the absolute nth degree of the maximum amount of mortgage income to help people qualify for home loans. My name is Teresa Timms, and I'm president of TDR Mortgage and Real Estate Group in Upland, California. I'm my trusty mortgage partner, Jocelyn Hidalgo, who is also a loan officer here at TDR Mortgage. A lot of you know her to have been assisting me and my clients in closing home loans. We just talked and identified. You started with me in November 2015, and then she's had a couple little hiatuses. Yeah. But now she's back. So I'm happy to have her. And I wanted her to come because the mortgage income, as we're talking about it, I don't have it. This is not a scripted program. This is just me talking about what I know. So it's like super easy to do. But then not having an exact format, sometimes I forget things. So I want to first talk to you about the basics of mortgage income. Our last broadcast, we got cut short. So Jules, do we really need to keep it at 15 minutes? Or that was just the last time because of the thumbnail issue?
I think that was just the last.
Okay. So mortgage income is very, very tricky. The thing that mortgage lenders look for are 2 years of solid, stable income, unless you were a student and you graduated as a nurse, let's say, and then you went and got a job as a nurse and you're getting paid as a nurse. And let's say as a nurse, you're working full time and you're getting overtime. Jocelyn, if you started your new job and you're getting base income of $40 an hour, but you're also working a shit ton of overtime because of COVID or whatever, can I give you that overtime income?
Not if you haven't been receiving it.
For how long?
2 years.
So do you always have to receive overtime income
Even
for 2 years?
Just a little bit. Like
no matter what. But what if I went out on maternity leave and I was out on maternity leave and that's like a legal thing. And so, but I, got it because I've been at that job for 2 years.
No, we can't give it to
That's
them.
Discriminatory.
Those are the rules.
So the rules are, it doesn't matter. You've had your job for 2 years. You have to have been receiving that income for 2 years. Okay. Now, I might be able to make a little bit of an argument if the person was out on maternity leave for a small time, or maybe they had previous jobs where they were working overtime. But overtime gets really tricky, especially when you're out of work. And right now, we've had a lot of people that were furloughed or out of work, and now they're back to work. Mm-hmm. So when we're looking at the overtime, maybe last year they had a lot of overtime, and maybe this year they had overtime pre-COVID, and then they went off work, and now they're back to working overtime, but they're not working as much overtime. What do you think the guidelines are on something like that?
I think we'd have to average and take off the months they didn't receive, because obviously they didn't receive that income. We might be able to get that approved if we remove those months that they weren't receiving.
So in a situation like that, it really comes down to documenting, because if you're not working the overtime right now, but let's say you're working a little bit, maybe you were working 20 hours of overtime, but now you're only working 5 hours of overtime. What matters is what you're working right now. And the key to even being able to use that overtime is the employer is going to have to write on their verification of employment that overtime is expected to continue and it's likely to continue. And if that strong verbiage is not there, you won't even get to use the overtime right now. COVID has given a lot of additional overlays. If income wasn't already kind of tricky enough, here comes COVID to come, jazz it up.
Sprinkle some extraness on the income.
Yeah. Jazz hands, COVID. Okay. I like the sprinkle effect. Though.
Yeah, it was
just sprinkle. Okay.
Yeah.
All right. So W-2 income. W-2 income is calculated what your base income is. So what's really cool is that we don't average base income. So if you're now making $18 an hour and last year you made $12 an hour, I'm not going to average that. I'm going to give you your base income, and then I would average overtime. What else would I average?
Any like commissions?
Commission,
Mm-hmm.
bonus income.
Uh-huh.
So commission, bonus, overtime, you always have to average that over 2 years. And it has to occur for 2 years, not almost 2 years, but 2 years. Okay, so that is W-2 income. Now, what about people that are W-2'd, but they are union workers and they've had like 20 jobs? How fun is that loan, Jocelyn?
So much fun.
I
It's
know.
like we said, documenting. So we have to get verifications of employments for all the jobs you've had.
Yeah, when we get
throughout the 2
I
years.
haven't had a union worker in a little while, thank
Yeah.
God. So I don't know what's going on with the whole union worker thing, but I have had union workers where they've had 12, 13, 14 jobs.
In the last 2 years.
And we literally had to do that many verifications of employment. And on the previous employers have to verify from when to when. And it was quite exhausting, I have to say, like very, very difficult. And then sometimes union workers have gaps of employment, and then you have to document the gaps of employment.
And they
so
collected unemployment. Well, from when to when did you collect
and then it's a lot. So union workers are a little bit tricky.
Mm-hmm.
Now, what about W-2 workers that go out on maternity leave?
They have, okay, so if they're on maternity leave and they're collecting unemployment from maternity leave, right? We can use what they're collecting now. We go back to what you're making now.
Right
now. We can't give you what you were making because we don't know when you go back if you're going to be making that, or what you're going to make, because there's no guarantee, because you're not making it right now. But we can use what you are making right now with unemployment, and we get to even gross it up.
Yeah. Tell me about grossing up, Jocelyn. What does that mean? It sounds so gross. Yeah.
So the rule is
oh yeah, red cup.
Yeah.
What am I really drinking?
Is it 5 o'clock somewhere? So the rule is you get to add on whatever percentage. It's different percentage for different
Well, I don't
income.
So on the last one that we did, we were allowed to gross it up 15%. So there's some back end formula stuff. I won't go into that, but generally speaking, maternity income, we can gross up 15%. We just recently
Which really means you can add on 15% of what they're actually making to
Yeah.
the income.
So
that's really all it means.
So if you make $4,000 a month, 4,000 times 0.15. So I can add on $600 a month to that. So 4,600. Now, maybe though you are making $5,000 a month, I can't give you that until you return to work. But that's a newer guideline. We used to not even be able to do that with maternity people. We always had to tell them, I'm sorry, you have to go back to work. But then mothers were being discriminated against because they'd had these secure jobs. Yeah, it's unfair.
So if you really want to get in something right now, and you are on maternity leave, you're receiving unemployment for maternity leave, we could do your loan with what you're making right now plus 50%. And if that doesn't help you, then we have to wait till you go back.
Yeah.
Mm-hmm.
Okay, so what about I have somebody that commission income. So when do I need to show? Right now, largely, if you're a W-2 wage earner, we only need to show your W-2s.
Mm-hmm.
And that's good because sometimes people write off business expenses when maybe they don't even really have a business or maybe they do. Maybe they have a side hustle, and maybe they filed a Schedule C because they have a side hustle business that maybe they made $2,000, but maybe they had $10,000 of expenses. So now they have negative income, supposedly from their side hustle, is what I've seen. So I use that loosely, supposedly, because there are people out there that do, that do have that. But I see it used as a tax strategy in many cases. and not having to show the 1040s, I'm not required to disclose stuff that's not relative to the case. So if someone's a W-2 wage earner, I just get their W-2s and support that and present that documentation to underwriting. When you have someone that has large amount of commission income, more than 25% of their base income, we do have to show the 1040s. If you have a rental property, we have to show the 1040s. Basically, think of it, we have to show the 1040s anytime schedules come into play. Anytime there's like a Schedule A, a Schedule E, a Schedule C, that's when we have to show the 1040s. And when we have 1040s, this is a good segue into the Schedule C. I want to make sure I covered all the W-2 stuff first. Can you go from a Schedule C, self-employed borrower, into a W-2 job? So let's say you are an accountant and you have a accounting business and you I don't know, let's say you're making $100,000 a year. And let's say you write off half of that. And you've had that business for, 15 years or however long, like 2 years. And then you're like, okay, I'm tired of this. And I got this really great opportunity to be an accountant for a Fortune 500 company. And they're going to pay you $150,000 a year. Okay. So can I go from 1099 Schedule C, self-employed person, into this W-2 position? And can I use that income?
I always get mixed up if it's like the other way around. Like because there's one we can do and the other way we can't.
Okay, so let me help you.
Yeah, help me.
I'll help you clarify that. So the way that works is you're going from a self-employed position that we only know what you make at the end of the year when you file your taxes. So all I'm going off of is like in 19, in 19 you had $100,000 of gross receipts. Now you showed 50. Maybe you did the same thing. Now you're going to a position that's paying you triple. It's paying you $150,000 a year.
Oh, so you can't, right? That's the one where you need the 2 years of W-2 income.
No,
I'm wrong.
No. So that one, what I would do is I would write a very, very strong, convincing letter, and I'd have the borrower, I'd do some investigative work about, tell me about this person probably didn't make the decision lightly to leave their company. Right. I mean, it's a big decision to go be self-employed and then go into a W-2 position. But maybe the cost of maybe the benefits were so great they couldn't pass up the opportunity. Right. And maybe it wasn't $150,000, maybe it was $100,000, So as long as they were working in that position, I would say if they were working in that position 1 month, I probably wouldn't be able to sell that because it's not enough. There's not enough meat there for me to do it. But if they had been there a few months and it had a really, really strong letter from not just a verification of employment, but I mean a good boy letter where they're talking about how great the employee is, how they have job stability there. They see them in that position for a good length of time. I could take somebody from a 1099 self-employed into a W-2. What I can't do is the reverse. Okay. I cannot do someone that was making $150 a year and they just started their own business and they have no history of their own and they haven't filed taxes.
Okay, right. Because then we can't verify how much you're going to write off. I mean, you could write all of it off. And then what? Yeah. Okay. That makes sense.
And
it's been a while.
What do most self-employed people do?
Write everything off.
Do they write half of everything off?
Everything.
Yeah. I don't know why I don't qualify for a home loan. Why? I'm so upset. I made $100,000 last year.
Well, on paper, you didn't. So if you don't pay taxes for it, we can't use it.
But I showed $100,000.
It doesn't matter. We go based off your net.
I don't understand this net that you're talking about.
So on your tax returns, if you're self-employed, you most likely do a
Schedule C.
Okay. So on the top, you'll have your gross income.
Oh, over here.
the circle, right?
Yeah, gross
Okay.
income.
Yes.
Can you go closer in, Jules? Are you?
Gross
Okay.
income.
Okay.
Okay. Then you have all your deductions in the middle, right? Everything you write off.
Okay, in the middle.
Yeah.
Over
And
here.
then all the way at the
Okay.
bottom, you have your net income.
Down
The last circle at the
here.
bottom. Yep.
Okay.
This here is what we can use to give you.
Not the top one?
Nope.
That's so unfair.
You didn't pay taxes on this much. You
Oh.
paid taxes on this much.
Oh, I get it. Say that again.
You didn't pay taxes on this. You paid taxes on this.
Okay. So if I didn't write off as much expenses and paid more taxes, then I can use more of the income.
Yes.
That is such an important concept. Thank you for clarifying that.
You're welcome.
So I get it. I cannot tell you how many people just are, their brains just go haywire. They don't get it. And then if you tell them, well, you know, we're getting to that time right now where it's tax time. So we counsel a lot of people at the end of the year. So that we have a lot of people coming up that are going to be calling us and saying, hey, this is what, you know, look at my 19 taxes and tell me what I need to show to qualify for something. And so we do that because I know the government would love for me to tell people to show more income and pay more taxes. So I was doing my governmently duty, you know, America. Yeah. So like, America. So on this particular example, this is a friend of mine. I'm not going to say his name, but it starts with a M and ends in an Ike. And he did, he did really good. He did really good. He listened to me. Good job, son. Good job. So look, he showed 59,000 gross receipts. And then he only wrote off about $10,000. So that's a really strong, he put himself in a really strong qualifying position. So I like that. Good job.
Yeah.
Yeah. Okay. So how do so this is 2019 Schedule C. So when we're calculating income for Schedule C borrowers, we look at 2 years. Do we always look at 2 years?
Always look at 2 years.
Are you sure?
Yes.
You're 100% positive?
Yes.
I think she's hinting at something.
Okay. Sometimes.
Unless we're doing some type of 1 year program, 1 year tax program.
No. So sometimes though, think about it. When we run, there are a couple underwriting engines that we have, Fannie Mae and Freddie Mac. Is that on my computer?
Yeah.
It's go to.
Okay. So there's a couple of underwriting engines we run loans through, Fannie Mae and Freddie Mac. And sometimes with a highly qualified borrower,
they'll ask us for just 1 year.
They'll ask us for just 1 year. If there's a high loan to value,
Right.
or I'm sorry, low loan to value, meaning they're putting a lot of money down. They have high credit scores. Yeah,
low.
It's just like
It's
pretty
a lot
file.
of like things that go in.
It doesn't happen. I don't see it that often.
Not with self-employed.
I don't see it that often. Sometimes we would get it on a Schedule C borrower. That's when I see it. But more often than not, it's 2 years. And then, Jocelyn, what if in 18 the person showed his bottom line? Let's talk off the. So the bottom line is, so his net profit was $100,000 in 18, 100,000 in 18, but then it was 75,000 in 19. So from 18 to 19, his income went down 25%. What income would you use to qualify him?
The most recent one and or average it for 2 years. So we would get the 18, and 18 you made X, and 19 you made X, divide that by 24 months. That's the income we would give you. Or, I mean, it depends how much lower it went, really.
Well, what I do typically, and especially right now during this COVID situation, I go off of the lower of the two, because in 18 you made 100, and 19 you made
75.
75. So 75 is how much
That's
you
a
make.
lot.
Yeah. And then in order to do more, the only way that I could do more is if the bar, I mean, we're so far into the year right now, right? Deep into 20. Thank God. Deep into 20. Next month is going to be wild. And then December is going to be the grand finale. I think there's going to be an earthquake in December. I'm
Oh
just,
my God.
what?
Mark it down. Mark it down.
No, I really do. I'm kind of borderline psychic, I have to say. I see things. No, I don't see things. I just know things. And that's kind of what I
she
think.
feels things.
Very feeling.
So if there's an earthquake, we know.
It's
who
not my
started it.
fault, though. It's not my fault. I just,
Teresa started. She started it.
I-
She's speaking it into existence.
I'm just predicting it. I'm predicting it. So, okay. So what I would do if somebody were saying, look, I've made, okay, so they made 75 in 18 or 19, but now this year they're making like $150,000. The only way that I could use that is if I had an audited P&L prepared by a CPA.
Yeah.
So that would be something that's
Not by
almost,
you, not handwritten, not you took a picture of the thing you wrote. No, it has to be from you.
yeah, and it would also need to be substantiated by a couple months bank statements to show those deposits. So those are the things where you go to your bank or you go to your credit union, they might not have the skill set because they only work off guideline. So guideline says you're going to use the lower of the two. But my brain is like, okay, how do I figure this out? This person needs to use this higher income. You know, we have to use this higher income. Otherwise, it's not even worth their while to go buy this, $500,000 house because it serves no purpose. So they want to go buy the 650 house because it has the pool. And why they're thinking is, why would you even why would I sell my house that's perfectly good?
Mm-hmm.
So sometimes you're solving problems and trying to figure out like how to get things done. And guess what? An audited P&L, it costs money.
Mm-hmm.
It costs the same amount of money as getting your taxes done.
Yeah.
But who cares? If it costs like $1,000 and it gets you the higher income,
Yeah.
just go do it. Just listen to me. And then you could have that house with a pool and be doing backstrokes in your heated pool by Christmas. Right?
Yeah.
I wish I had a heated pool. I used to have a
She has the
heated pool.
ocean, so it's
Yeah.
Do you know how cold the ocean is at my house? It's terrible. It's
No,
so
I
cold.
don't. I do not actually.
I do not. Okay, so I think we covered this. I think we covered the income. So Jules, you have been hosting the events and coming up with all of these questions, when we kind of first started. And then you're also a young person just entering the phase where you're thinking about homeownership in the future. What are some questions that you think would be that you can think of that people might want to know about?
I think because I have the background in real estate, I get a lot of questions like from my friends just asking me stuff. And I remember getting a question a couple months ago, maybe 6 months ago, and he asked me if he and all of his friends he's my age, 19 years old, I went to middle school with him, I've known him for a very long time, if he and all of his friends could buy a house together. He didn't even know that he needed to have credit to show that. So credit is super important. Super important. And one thing that I hear over and over and over again is not only, okay, first of all, you need credit. Second of all, how to use it to.
Do I have you on there?
Yeah.
Okay.
So how to use it as well. Like, don't use more than 30% of
So
your
credit usage.
That's
Okay.
probably the number one. Like you need a
Because
credit
people,
card to buy a house.
people don't know that.
And then jobs too. Like not even just people my age, obviously. People of any age, of any education.
So do you think, how we talked about somebody in college, graduating in their profession and then going and buying a house with only a few months on the job? Can you do that with high school? Can you
No.
get out of high? No,
No.
so you already know, right? You're
No.
like, no.
So that's another benefit of going to school too.
Oh, you're right. Right. Yeah.
Yeah.
I'm like, you know, I'm not going to school right now.
So somebody getting right out of high school, they would need to go into the workforce, be in the workforce for 2 years before they could buy a house. Or what could they do?
If you got a college degree, like we talked about earlier,
Or a
about
cosigner.
Yeah.
So, or a cosigner, somebody right out of college, they have their first job, they've only been on the job a couple of months, or maybe they're not even working. A parent can co-sign for that person, and they can go on the loan too. You can go on the loan, but if you're making income, the income won't count
Right.
because you haven't been working
Brand
for 2
new.
years. Yeah, you're brand new. You're new here, so you would need, but you could still have the benefit of home ownership if you could have someone co-sign for you. One thing I thought of is part-time income. We didn't cover part-time income, and then we didn't cover people that have 2 jobs. Who has 2 or 3 jobs?
A lot of bartenders.
Okay.
Young people.
Yeah, a lot of young people. I
And
or
nurses.
nurses. Doctors.
Yeah.
Work for 2-3 different hospitals.
So part-time income, unlike, so let's say your part-time income, you're making you're working 20 or 22 hours a week. Part-time income is averaged over 2 years. Part-time income is always averaged over 2 years because it's part-time and not guaranteed.
Right.
The exception to that, the only exception is if the employer, let's say last year you had a history of working 15 hours. Not that many people work 15 hours and buy a house, but let's just say they have a history of 15 hours. Now this year they're working 22 hours. Normally we would average that income out unless the employer puts in writing that 22 hours is guaranteed. And we have evidence of year-to-date calculations showing that they've been working 22 hours. So you have to have a history. We have to have pay stubs. You can't be working 16 hours and then all of a sudden 1 month show up and you're working 22 hours and your employer guarantees it. That's not going to fly. So things have to make sense, but you also know how you can structure things to push.
Right.
And a lot of times I'm really, really aggressive on income. Often when my processor tells me I can't do something, I think it's because I know, she's like, you can't do that. I'm like, yes, I can. Watch me. And where I grew up, I started loans originated at Marina Mortgage, and I cut my teeth and was educated on structuring a loan and what an underwriter needs to make a decision. And an underwriter is a judge. So think of an underwriter as a judge and think of me as an attorney, a super badass attorney that really knows the law, right? Mortgage law. And so I will document a file to the degree that the underwriter will make a concession to my income based on the documentation that I provided. For example, if I'm a little bit short in a certain area, but I'm able to get a letter from the employer to substantiate this, or I'm able to document what is that? What are those things called? Those circumstances, those additional layers. What is it called? So underwriters, they have a duty to the government entity that they're underwriting in accordance to, whether it's Fannie Mae, Freddie Mac, FHA. So they underwrite in accordance with guideline. And if they step out of the guideline, or maybe they walk on the furthest edge of the guideline, if they put their name to that and that loan later goes into default, their name goes on a naughty list. Or if they're super aggressive and they approve a loan with really high compensating factors, they approve a loan with really high ratios, they have to have documentation in the file to justify and show FHA, I made this decision based on these substantiating facts. And so I always take my job like I am, because I am like an attorney, but I'm not. You know what I mean? It's my job.
Yeah,
I gather the facts and I gather the information and I give the ammunition to the underwriter. And so we do it when we need to do it. We do it when it's necessary. I don't walk around all day long, substantiating cases with compensating factors, but when I need to do it, I can do it.
Yeah.
So
she's great at dissecting.
So part-time income. So what if somebody has 2 jobs, Jocelyn? They have 2 jobs right now. How long do they have to have had those 2 jobs?
Well, they have to have had at least, we have to be able to document that you have had 2 jobs for 2 years, regardless of if they're the same jobs or different jobs, like people that work in the dental industry, right?
Yeah.
I work at a dental office part-time here, part-time there. That's great. But how long have you been there? And have you always had 2 jobs?
So one job I've had for 15 years, and the other part-time job I started a year ago, but I want to buy a house using both incomes.
Well, you have kicked ass on that loan and have pushed it to where they've allowed us to use a percentage of that second job, not the full income.
If you can prove that they have had part-time income. So maybe they've had this one job the whole time for 10 years, and they part-time income, and then they don't part-time income, and then they part-time income. Yeah. But if you have a part-time job that you've had steady for 10 years, and you've got a second job for 6 months, you can't use that second job, because remember, jobs for 2 years to use the income.
You have to have had 2 jobs.
Yeah.
Continuously.
And so sometimes we have people with 3 jobs. Like I have a lot of nurse LVNs. Yeah, caregivers too. So you have to have been receiving those multiple jobs for multiple years in order to qualify. Okay. So part-time income, 2 jobs. Is there any questions or anything else that you can think of, Jules?
No.
Okay. What do you want to tell our viewers about next week?
Just that
we don't know what the hell we're going to talk about next week.
I have no idea. I was going to pull something.
So next week we're going to do a market update. So Tuesdays at 3, market update, followed by the theme of the week. And so I've had some people talk to me about, somebody was talking to me about forbearance. Hey, what are the rules on forbearance? We haven't really touched on that in a little while.
A good one, because it has to do with
a lot that's going on right now.
Yeah. And I also think maybe we can talk about go one step further on the income theme and talk about corporate income and people with multiple properties, right? So
those are fun.
Those are so fun. So the next part of income. So let's do income next week too, where we go a little bit further and deeper into more complex income cases. So let's talk about qualifying when you have not the Schedule C, right? This is something that you file your 1040, you get 1099. So this income that this gentleman showed, this income right here, he receives 1099s, and that's what those represent. Others may have a cash business and they get checks. Maybe they sell goods or services, and so they get checks. And what about people though that have actual corporations? They have S corps, they have C corps. What are the additional income qualifications for that? What are the, what is the other thing I said? Corporate income and Schedule C income. So that is going to be people, not Schedule C, Schedule E. People that have properties, multiple properties. That's probably one of the more challenging things. Like I have somebody right now that's got Schedule C, he's got a couple corporations, and he has 4 properties, and then the property's got duplex, triplex, and it really gets very, very hairy. And so you just have to break it down and get all the information and get all the facts. But we'll just kind of touch on that a little bit. That's much more complex. Each case is very, very different, but we're just going to kind of throw the qualifications out there for people so that they have something to follow.
Just really quick, Joe Dela Cruz, V13 asks, how about what the president's role will play with the real estate market? So the election. We answered that, and I think.
Well, I can tell you full well that if the Republicans win, it's going to be business as usual, and the stock market, people won't. It will be business as usual. Mm-hmm. if the Dems win, the amount of restrictions that they're putting on the property owners and the smaller property owners and just the taxes and everything, it won't be good. I'm really recommending everyone to lock their loans ahead of next week. I think that either way, rates are going to go up next week. So rates look really great this week. So we're pretty much locking in our full pipeline right now.
Lock happy.
We're lock it. Jenna, lock that loan. Rates looked really good yesterday. That was like one of the best days in a couple of months.
Yeah.
So Joe, thank you for that question. What do you think? Like, what are your thoughts? I think that most business owners know that there's pretty much going to be hell to pay if the Democrats get into office. That's a common thing. And that's simply why you have most business owners on the Republican side, just because it is a pro-business party. And there's so many.
He says he agrees.
Yeah. Okay. All right. Well, thank you guys so much for tuning in. I really appreciate the support. I appreciate all the comments. We're going to have a gift to give away next week. I'm not sure what it is, but it's going to be something cool. It's not going to be some dumb coupons. You know, I went to that place and they limit you because it's outdoors. Like the lady told me, she's like, no, these are really good for when we're open inside. And I'm like, well, when's that going to be?
Thanks.
So I'm like, ugh. So anyway, we're going to give away something exciting. So if you guys want, put your comments down. Like if you want me to give you something, what should it be? If you want a gift, give me some suggestions on some good gifts. Let's give away something good, like $100 something. Yeah.
Comment below.
Yeah. Okay.
Alrighty. We also got a couple of suggestions for some what's it called?
Topics.
For some topics that we can talk about in the future. So Coral_like the reef gave us rent control and also the prop that displaced families. So some controversial propositions. So
Coral, that's that one prop. I still need to study that.
So that's something that we want to talk about in a YouTube video, Coral.
We need to really do that because the election is Tuesday. Like I'm going to do that. I'm going to sit down. I'm going to study that. So Brad Wallace is saying he recommends that we give away a new car. Brad, you're not looking at Oprah and Ellen over here. So
wrong show.
Totally wrong show.
Wrong channel.
Raylene is saying lock the loans. That's a TDR mortgage loan officer and realtor. She's locking those loans. Nuage Design is saying, what if you want to buy another home after you bought a duplex via FHA 7 months ago? Well, you owner occupied an FHA home loan. And typically those loans are thought to be an owner occupied purchase to occupy for a minimum of 1 year. So if you went to go purchase another property, owner occupied, you would be declined.
So you have to go conventional investment property for your other home.
Yeah. So
until you live there for 1 year and then you can.
Yeah, I would say give it a year and then you can make a case because the FHA loan is owner occupied. Good question.
And
I really like that.
when you're ready.
Yeah, do that. So I didn't realize that we could see these comments on here. Alma Carino said, don't say that. I wish I would have had this in context of when it was in. Hey, thanks for the comments, you guys. This is funner with comments.
Great. Yeah, thank you for tuning in. Tune in next week.
Hey, John,
give us a call.
Where should they call? They should call us at where?
909-920-3500.
All right. Until next
it's
time.
Like a commercial.
I know.
Bye, guys. Thank you, Jules.